Title: Deconstructing GDP, Defining True Economic Productivity. Introduction. Gross domestic product, GDP, is the default scoreboard for national success. Presidents cite it. Analysts worship it. Journalists splash it across headlines. If GDP is up, we're told the economy is growing, the country is thriving, and policymakers are doing their job. But here's the problem. GDP is not what we think it is. GDP measures the total dollar value of goods and services exchanged within a country. It tracks motion, not meaning, dollars spent, not value created. It cannot distinguish between a productive investment, an inflated price tag, or an extractive tax skimmed off someone's fuel tank. In fact, many of the so-called positive contributions to GDP, like inflation, speculative finance, and government-imputed values, are not productive at all. They make the number go up, but they don't make life better. Worse, they often erode purchasing power and hollow out real economic health while giving the illusion of growth. This exposition challenges the supremacy of GDP as our primary economic compass. We'll dissect its hidden distortions, expose the gimmicks and phantom entries, and offer a new litmus test for economic truth. If an activity increases nominal GDP but reduces real purchasing power, it fails. That's the core principle. And with it, we can begin to redefine growth, not as a race for bigger numbers, but as a path toward real productivity, resilience, and prosperity that lasts. Section 2, Understanding GDP, the Basics and the Blind Spots. To begin our deconstruction, let's get clear on what GDP actually is, and more importantly, what it isn't. What GDP measures. At its core, gross domestic product, GDP, is the market value of all final goods and services produced within a country during a specific time period. It includes everything from smartphones and steel to accounting services and auto insurance. The most common formulation is GDP equals C, consumer spending, plus I, investment, plus G, government spending, plus X minus M, which means exports minus imports. Consumer spending, what people spend on goods and services. Investment, what businesses spend on things like equipment, buildings, and inventory. Government spending, on things like roads, salaries, and public services. Plus exports, things we sell to other countries, minus imports, things we buy from other countries. This gives us a snapshot of the total economic activity expressed in monetary terms. Nominal versus real GDP. But here's where things get tricky. Nominal GDP measures the raw dollar value of that activity, unadjusted for inflation. Real GDP adjusts for inflation to reflect the actual volume of output. The relationship is approximated as nominal GDP is approximately equal to real GDP multiplied by 1 plus the inflation rate. Or flipped around, real GDP is approximately equal to nominal GDP divided by 1 plus the inflation rate. In simpler terms, to find the real size of the economy, real GDP, you take the inflated dollar amount, nominal GDP, and adjust it down for how much prices have gone up, inflation. This distinction matters immensely. A country can post 5% nominal GDP growth, but if 4% of that is just inflation, then only 1% is real output growth. Without adjusting for inflation, GDP becomes a hall of mirrors, reflecting dollar increases that may not represent any additional value. GDP's blind spots. GDP's real problem isn't just inflation. It's what GDP includes and what it assumes adds value. 1. Imputations. These are estimated values for things that aren't actually bought or sold in the marketplace. In the U.S., GDP includes the imputed rent of homeowners, what you'd pay yourself if you rented your home to yourself, and the value of employer-sponsored health insurance, even though there's no market transaction. These phantom entries now make up 14% of U.S. GDP, about $4 trillion in 2023. 2. Government spending G. All government spending counts as a GDP contribution, regardless of whether it's productive or not. Whether the government builds a bridge or overpays for paperwork, it all enters GDP as equal value. 3. Cost-based inflation. When healthcare costs rise or college tuition soars, GDP increases, even if the service hasn't improved. The public is paying more but receiving the same or worse. GDP sees the higher price tag and calls it growth. 4. Financialization and services dominance. Services like legal fees, lobbying, and financial consulting dominate high GDP economies like the U.S. They bring in large revenues but often reflect complexity, litigation, and rent-seeking behavior rather than productive output. What GDP doesn't measure: resource depletion, household labor or informal care, wealth distribution, environmental degradation, quality improvements, or technological efficiency. In short, GDP tells us how much money moved, but not whether we're better off. Section 3, the inflation illusion, when price increases masquerade as growth. Let's peel back one of the biggest distortions embedded in GDP: inflation. Inflation is simply the rise in prices over time. But when prices go up, GDP goes up with them, even if we're producing the same amount of goods and services. This leads to a dangerous illusion. The economy looks like it's growing, but no new value has been created. How it works: imagine a grocery store that sells the same basket of goods year after year. Year 1, basket costs $100, GDP sees $100 of activity. Year 2, basket now costs $107 due to inflation. GDP now sees $107 of growth. But has the economy really grown? Have we produced more food, created more jobs, or improved quality? No. The only thing that changed was the price tag, not the productivity. Yet, GDP registers this as a 7% increase in output. Example: real growth versus nominal growth. Suppose real GDP grows 1%, inflation is 4%. Then, nominal GDP is approximately 1.01 multiplied by 1.04, which equals 1.0504, or about 5% growth. Headline: GDP grows 5%. Reality: only 1% more was actually produced. This math is technically accurate, but fundamentally misleading if it's not clarified. Policy gimmicks built on the illusion. Governments know this trick, and they use it. If we can inflate GDP faster than we grow our debt, we look solvent. This logic underpins debt monetization: inflate your way out of obligations, bigger deficits, as long as nominal GDP outpaces debt to GDP ratio. But the cost is enormous. Erodes real wages, punishes fixed income savers, devalues currency trust, makes inequality worse. It's economic sleight of hand, like balancing your checkbook by raising the prices at your own lemonade stand. Inflation is not productive. GDP counts price hikes as growth, but inflation isn't output, it's a distortion, a mirror trick, a way of making the numbers bigger without adding substance. More dollars, same stuff. That's not growth. That's just a different way of keeping score. Section 4, extractive mechanisms hidden in GDP. Now we turn to one of the most misleading aspects of GDP. It counts extractive activity the same as productive activity. In other words, GDP doesn't care whether a dollar spent creates value or just moves money around. If it flows, it counts. But not all flows are equal. Taxes on productivity treat it as growth. Let's take a concrete example. You fill up your gas tank for $50. Included in that is $7.50 in fuel taxes. That tax doesn't produce fuel, it doesn't add energy, it doesn't even improve infrastructure most of the time. It's an extraction, a skim from a productive transaction, and yet GDP counts it as if it were value created. The government applied a tax, and the economy grew. Really? That's like charging a cover fee for entering your own garage and calling it a service. Financial engineering disguised as output. Now let's talk share buybacks. A company earns $10 billion and uses that to buy back its own stock, pushing the share price higher. No new factories, no hiring, no R&D, just fewer shares and a higher EPS, earnings per share. GDP counts this as investment. Wall Street calls it growth. But in reality, it's a recycling of profits to boost asset prices, not to increase productive capacity. This is financial theater, masquerading as economic output. Overpriced services inflate GDP, not value. Legal fees, health insurance premiums, investment advisory services. These sectors have ballooned in cost, not necessarily because they're better, but because they've become entrenched and insulated. U.S. healthcare is over twice as expensive per capita as most of the developed world, yet outcomes are often worse. GDP, however, registers this higher spending as a bigger economy. So when legal disputes get more expensive or insurance premiums rise, GDP says, excellent, more economic activity. Reality, we're paying more for the same or less. Extractive isn't the same as productive. When GDP treats extractive mechanisms like sales taxes, legal complexity, financial churn, administrative bloat as equal to building bridges or producing goods, we get a distorted image of growth. It's not just misleading. It incentivizes waste and rent seeking. This content is brought to you by Bobby Gigs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5, the Global Comparison Trap, PPP, and Real Output. GDP not only misleads us about domestic productivity, but it also distorts how we compare nations. The world scoreboard is rigged in favor of countries with higher prices, not necessarily those with higher output. Let's unpack that. The hotel room test, nominal distortion in action. You book a 5-star hotel room in New York, $1,182 per night. Book the same hotel brand, same star rating, same week in Shanghai, $286 per night. GDP accounting says the New York hotel stay contributed 4 times more to economic output. But did the U.S. hotel produce 4 times more linen? Did the guests get 4 times the service? Did the staff work 4 times as hard? No. The difference is price level, not productivity. GDP just counts how much you paid, not what you got. Purchasing power parity, PPP, the reality filter. This is where PPP comes in. Purchasing power parity adjusts GDP to reflect what money actually buys in each country. It helps answer, what's the real size of a country's economy when we level the playing field? When we compare GDP using PPP, China overtakes the US as the largest economy. Emerging markets like Indonesia and Turkey leap ahead. High-cost countries like France and the UK fall off the top 10. PPP shows what many feel intuitively. $100,000 in New York City doesn't go nearly as far as $100,000 in a smaller, cheaper city or in another country altogether. Real output versus notional dollars. Let's take infrastructure. China builds entire metro systems for the price the US pays to build a single subway station. China produces 1.3 billion tons of steel annually. The US, less than 100 million tons. Chinese ports dominate global traffic, energy use, and physical goods production. By raw output, China's economy is massively productive. But traditional GDP doesn't capture that. Instead, it captures price tags, which are inflated in high-cost economies like the US. GDP doesn't reward efficient builders, it rewards expensive ones. Why it matters. If we judge global economic power by unadjusted GDP, we inflate the strength of costly economies, we underestimate productive, efficient ones. Policy decisions, trade agreements, and geopolitical strategy are built on this skewed data, and that leads to real-world misallocations. Section 6, Policy Implications and the Debt Illusion. Let's talk about how this distorted picture of GDP is not just a statistical quirk, it shapes national policy, and often in the wrong direction. Politicians, central bankers, and economists use GDP as their primary excuse for printing money, running deficits, and pushing financial engineering schemes. But if GDP itself is misrepresenting economic health, then the policies built on it are fundamentally flawed. The dangerous logic of nominal GDP targeting. Here's the logic you'll often hear from policymakers. As long as nominal GDP is growing faster than our debt, we're fine. This becomes a rationale to borrow more, print more, spend more, because even if debt grows, as long as GDP is inflating faster, on paper, it looks sustainable. But let's be clear. If GDP growth is driven by inflation, not productivity, it's a mirage. Inflating away the debt equals stealing from savers. Inflation doesn't eliminate debt. It just erodes the real value of the dollars used to repay it. Bondholders and pensioners get paid back in debased currency. Fixed income savers are quietly taxed through loss of purchasing power. Wage earners fall behind as prices rise faster than their income. It's a stealth transfer of wealth, from the prudent to the reckless. And all the while, GDP keeps flashing green. GDP as political cover for bad policy. GDP growth is often used as the performance metric for policymakers. But if that number is puffed up by asset bubbles, inflation, financial churn, government spending funded by debt, then politicians can claim success while the real economy deteriorates. It's like celebrating a higher income while ignoring the fact your rent doubled. Case study, sales tax on fuel. Let's revisit a key example. You buy gas. The government adds a sales tax. That tax revenue goes into government spending, and guess what? GDP goes up. But has the economy improved? Has fuel supply increased? Has productivity improved? Has the consumer gained anything? No, you just paid more. The government took a slice. GDP called it growth. That's not economic output, that's fiscal siphoning. Bottom line, policy built on sand. When GDP is inflated by illusions, monetary policy loses its anchor. Fiscal policy becomes performative. Public trust erodes. We end up managing appearances, not outcomes. Section 7, Introducing the litmus test for true productivity. Up to this point, we've exposed the cracks in GDP's armor, its distortion by inflation, its vulnerability to financial theater, and its abuse in policy decisions. Now it's time to offer an alternative. A simple, powerful filter to separate real progress from economic illusion: the litmus test. If an activity or policy increases nominal GDP but reduces real purchasing power or fails to produce tangible output, it is not economic growth. It is distortion. Why purchasing power is the gold standard. Real prosperity isn't about how many dollars circulate, it's about what those dollars can buy. If nominal income rises 5%, but your rent, food, fuel, and insurance rise 7%, you are poorer, even if GDP says you're richer. That's why purchasing power is the non-negotiable benchmark for real economic progress. It reflects affordability. It preserves savings. It empowers households. Any policy or economic activity that shrinks this capacity fails the test, no matter what the GDP number says. What passes the test? Building infrastructure that reduces friction and enhances future productivity. Manufacturing tradable goods that contribute to long-term export capacity. Innovations that improve quality of life or lower costs, e.g. renewable energy, AI optimization. Investments in housing, transport, or digital infrastructure that expand access. These don't just move money, they move real outcomes. They're durable, they're inclusive. They're the bedrock of real wealth. What fails the test? Inflation-driven price increases that inflate GDP without raising output, extractive taxes that skim value from productive sectors, share buybacks that juice EPS while ignoring long-term investment, imputed non-market values like homeowners renting to themselves, government spending with no productivity return, e.g. administrative bloat. These entries look like economic activity, but they're often just numerical noise, political theater, or fiscal circularity. The power of a simple standard. This litmus test doesn't require a PhD. It doesn't rely on complex models. It asks two simple questions. 1, does this make life more affordable and productive? 2, does this create real, measurable output? If not, then it's time we stop calling it growth. Section 8, a call for reform toward honest economic metrics. We've established the core problem. GDP, as currently measured, rewards financial motion, not economic meaning. It's time to rebuild the scoreboard. Because when we measure the wrong things, we incentivize the wrong behaviors. If inflated healthcare costs, government debt, and speculative finance all count as growth, then we've built an economy that grows by cannibalizing itself. We need new tools, clearer lenses, a system that honors real productivity, not illusions, not accounting fiction, and not political convenience. Proposal, productive GDP or net real output. Let's imagine a better metric. Call it productive GDP or net real output, NRO. Here's what it would track. Actual production of tradable goods, public and private infrastructure investments, affordable access to essentials, housing, energy, healthcare, productivity per unit of input, efficiency, preserved or improved purchasing power, energy and material throughput per capita. And what would it exclude? Inflation-based price increases, financial games like share buybacks, phantom imputations, extractive sectors that don't produce tradable or durable value. This rebalanced metric would not only track the economy's size, but its health, resilience, and direction. Metrics rooted in energy, access, and efficiency. Energy consumption, transportation speed, manufacturing throughput, and housing availability are not sexy metrics, but they reflect what real people experience every day. They're harder to manipulate, and they reward systems that are lean, productive, and scalable, not bloated and inflated. We can also integrate digital metrics, access to reliable internet, blockchain-based transaction flow, decentralized economic participation. These emerging measures reflect a modern economic reality that GDP was never designed to capture. The role of technology and decentralized systems. The rise of crypto, DeFi, and digital assets offers a chance to rewire our economic measurement from the ground up. In these systems, value is recorded transparently. Real utility is easier to trace. Extraction stands out like a sore thumb. Imagine a metric that rewards open access, financial inclusion, and productive participation, not just institutional leverage and top down spending. We're not far off. Why reform matters now? If we fail to upgrade our metrics, we'll continue misallocating capital. We'll inflate bubbles while families fall behind. We'll erode trust in our institutions and in the numbers they publish. But if we build a better scoreboard, we change the game. We can redirect incentives toward creation, affordability, and resilience, and away from bloat, speculation, and spin. Section 9, Conclusion. GDP has long stood as the dominant scoreboard of economic health, but what we've uncovered is this. GDP is a broken compass. It tracks velocity without direction, motion without meaning, dollars without depth. It counts extractive taxes as growth, inflated costs as output, financial engineering as investment, phantom values as production. And when these elements combine, they give us a rising GDP number. While the real economy stagnates, households struggle, and purchasing power slips away. The illusion we must leave behind. We've mistaken inflation for growth. We've mistaken financial churn for economic progress. We've mistaken bigger numbers for better lives. The result? A distorted economy optimized for optics, not outcomes. The litmus test is our new compass. So here's the shift we must make. From GDP watching to reality checking. From chasing nominal growth to building real, usable value. Our litmus test gives us clarity. If it doesn't preserve or improve purchasing power, if it doesn't produce real tradable or durable value, it is not economic growth. What we measure shapes what we build. If we measure spending, we'll optimize for spending. If we measure real productivity, we'll optimize for resilience. If we reward fake growth, we'll build an economy that excels at faking it. But if we reset the scoreboard, if we demand metrics rooted in real output, affordability, and efficiency, we can rebuild an economy that works not just on paper, but in practice, for people and for generations.